Welcome back to the deep dive.
Yeah.
Today we're going to be taking a look at, well, a classic.
Oh, yeah.
A Random Walk Down Wall Street.
Okay.
It's by Burton G. Malkiel.
Right.
This book has been around for 50 years. 13 editions.
Wow.
And it's still one of the, I think, best guides out there for investors. So
Honestly, a classic.
yeah, and we're going to be, pulling out the most interesting pieces and
The good stuff.
yeah, hopefully you can walk away with a better understanding of
How it all works.
yeah, how the market works, how to make it work for you.
That's the goal.
Yeah.
It's really incredible, how relevant Malkiel's ideas still are after all this time.
Yeah.
His argument about indexing,
Right.
it's basically you buy and hold a bunch of different stocks. He says it's a way better strategy than trying to pick stocks or time the market.
Oh, okay. So let's get into this whole random walk thing.
Yeah.
It sounds kind of chaotic.
A little bit.
Does Malkiel think that stock prices just kind of bounce around randomly?
Well, he uses that analogy, the random walk, to show just how hard it is to predict stock prices.
Okay.
They're always changing because of all this new information coming in all the time.
Yeah.
It's if you're trying to guess where a drunk person's gonna go next.
Okay, yeah. I've heard him compare it to
Oh, yeah.
a chimp throwing darts at a list of companies.
Yeah, that's a good one.
That's going to be rough for a lot of stock pickers to hear.
Well, a lot of people get that analogy wrong, though.
Oh, really?
He's not saying that all stocks are the same,
Right.
or that investing is pointless.
Yeah.
It's more that no one knows which stocks are going to do better than the others.
Okay.
You might get lucky for a little while,
Mm-hmm.
but over time, it's really hard to beat the market.
Consistently.
Consistently, yeah.
Why is that? Is it that there are just way too many factors?
It's really about how good markets are at using information.
Okay.
Think of it like thousands of really smart people all looking at everything, every bit of news, every earnings report.
Uh-huh.
All that info goes right into stock prices, super fast.
Right.
So it's not that prices are always right,
Okay.
but it's really hard to know more than everyone else in the market.
So what does all that mean for me,
Yeah,
the average investor?
right.
Should I just give up and put all my money in a savings account?
No, definitely not.
Okay.
It actually helps us know what works best.
Okay.
Like indexing, remember?
Right.
Instead of trying to be better than the market, you can just try to get the same returns as the market.
Okay, yeah.
You do that through, lots of different investments and low-cost stuff.
Okay.
That's where index funds come in, but we can get into that later.
All right. That makes me feel a little better. But, sometimes it's hard to resist.
I know what you mean.
All the hype.
The hype. Yeah.
You hear about people getting rich so fast in the market.
Oh, yeah.
I know Malkiel talks about, bubbles, those times when everyone seems to go a little crazy.
Yeah, a little crazy.
I think you used tulip mania as an example, right?
Oh, yeah, absolutely.
Yeah.
The tulip mania back in the 1600s in Holland,
Okay.
that's the best example of how people can get carried away.
Okay.
People were trading their houses, everything they had,
Really?
for tulip bulbs.
Wow.
Can you imagine?
That's crazy.
It's wild.
But I guess we've seen it more recently, like the dot-com bubble
Oh, for sure.
back in the 90s.
Yeah, totally.
All those internet companies
Yeah.
with crazy ideas.
Crazy valuations. It was like everyone thought prices would just keep going up forever.
Yeah, it seemed like it.
It did. It did.
Yeah, Malkiel calls that a castle in the air mentality, right?
That's right.
Yeah.
Investors get so focused on what could be that they totally forget about what's actually happening.
Yeah, mentals.
Exactly. The fundamentals. And it's not just those two,
Right.
Malkiel goes through a ton of bubbles. The South Sea bubble, back in the 1700s, the Japanese real estate bubble in the 80s.
Oh.
And they all follow the same pattern.
What's that?
Everyone gets excited, prices go way too high, and then pop.
Ouch, that pop doesn't sound good. So what can we learn from all this? How do we stay away from all that craziness?
Well, you got to know about these patterns and not just believe all the hype,
Okay.
Markets are driven by logic and emotion.
Right.
Sometimes emotions and crowds just take over.
Yeah.
You got to really understand what you're investing in.
So we can't just follow the crowd, but what about all those tools and techniques,
Oh,
to try to predict the market, like technical analysis? That's where you look at charts for patterns. Does Malkiel think that works?
He spends a good chunk of the book explaining why those don't work.
Really?
He's especially skeptical of technical analysis. He
Oh.
thinks it's more like astrology.
So he doesn't like those who swear by charts and patterns.
Not really. He even tells this funny story. He noticed that a lot of the people talking about technical analysis weren't doing so well themselves.
Oh, that's funny.
Yeah, he calls it the holes in the shoes indicator.
Okay, so charts aren't the way to go. But what about fundamental analysis?
Right.
That seems a little more realistic.
Yeah.
You look at the financials, earnings, dividends
Yeah.
to find the real value.
The intrinsic value.
Yeah. Malkiel likes that, right?
He does say it makes more sense than just looking at patterns.
Yeah.
It makes sense to know about the company and its future.
Yeah.
But even that has limitations.
So it's not a perfect way to know the future.
Exactly. The information can be wrong, the valuations are never exact.
Right.
And sometimes the market just doesn't act rationally.
Wow. Oh,
You can do all the research and still make a bad trade.
So the market is tough to beat. And even all those techniques have problems. But Malkiel does give us some advice on what to do.
You're right. He gives us a set of potentially useful stock picking rules, for those who want to try and beat the market.
Yeah.
But before we get into those, he talks about this really cool idea, behavioral finance.
Oh, yeah. That's where he talks about our brains, right?
Yeah.
And how they can mess up our investments.
Exactly. It's like we're designed to make mistakes.
That's scary.
I know. We'll explore how our psychology,
Right.
all those mental shortcuts and biases
Right.
can lead us astray.
Wow.
And we'll see how understanding them can help us make better choices.
Okay, that sounds fascinating. But before we get into all that, let's take a quick break. We'll be back in a flash to talk about Malkiel's rules and more. Welcome back to the Deep Dive. We're talking about A Random Walk Down Wall Street by Burton G. Malkiel, and just before the break we were discussing how our own brains can sometimes get in the way of making good investment choices.
Right, exactly. Malkiel looks at all this interesting research in behavioral finance, showing how our psychology, it kind of leads us to make the same mistakes over and over. It's not just about being smart, it's understanding these hidden biases that we all have, especially with money and risk.
Okay, so what are some of these biases that he talks about? I have a feeling I'm going to see myself in some of these.
One of the big ones is overconfidence. We get this feeling like we're in control, especially when things are going good in the market.
Right.
We start thinking like, I've figured this out, I can pick winners.
Yeah.
But it's usually just luck. We're just riding a random trend.
Yeah. Been there, you feel like you're a genius, and then bam, market turns. You're like, what just happened?
Exactly. And then there's that confirmation bias. We look for information that proves we're right.
Great.
Even when we're wrong.
Oh, wow.
We ignore anything that says we're wrong, and we keep making the same bad choices.
So even when we do our research, we might be looking for the answers we want instead of seeing what's really there.
That's it. And then there's loss aversion.
Okay.
Malkiel says this is one of the biggest things that affects investors.
Really?
We feel losing money way more than gaining money.
Oh, I get.
Even if it's the same amount.
Oh, yeah, I can definitely relate to that. It's so hard to sell something when it's losing money. It's like you just keep hoping it'll come back.
Yeah.
And then you end up holding it way too long.
That's loss aversion. And it can lead to all sorts of bad choices.
Like what?
Like selling winners too early and holding on to losers too long. It's like we get attached to these investments, but they're just, numbers on a screen.
So knowing about these biases is helpful.
It is.
But how do you actually fight them? They seem pretty hardwired,
That's the tricky part. Malkiel does have a few ideas. A lot of it is being honest with yourself.
Okay.
Like know that you have these biases.
Right.
And set up some rules to help you make better choices.
What kind of rules?
Like decide when you'll sell a stock before it happens so you don't get emotional about it.
Right, like taking all the emotion out of it.
Exactly.
But still, the market feels like a scary place sometimes.
I know.
I know Malkiel likes index funds, but does he give any advice for people who want to try picking stocks themselves?
He does. He has 4 potentially useful rules for picking stocks.
Okay, let's hear them.
But first, he reminds us, these aren't magic formulas, and even with these rules, it's still really hard to beat the market consistently.
Okay, got it. So, lay them on me. What are Malkiel's 4 rules for stock picking?
All right, rule number 1. Find companies with strong earnings growth and high profitability.
That seems pretty basic.
It does, but remember, you're not just looking at what they've done. You're trying to guess what they'll do in the future, which is hard.
Yeah, past performance doesn't guarantee future results, right? So how do you know a company's earnings will be good in the future?
That's where it gets tricky. There's no one answer. You have to look at the whole picture, the industry, their competitors, management, what new products they're making. You want to see if they can keep growing and making money.
Okay, strong earnings, profitability, check. What's rule number 2?
Don't pay too much for a stock.
Okay.
Don't get caught up in all the hype and overpay because you think it'll be amazing.
Right.
He suggests looking at the price to earnings ratio.
Okay, I've heard of that. But what does that actually mean?
It compares the stock price to how much money the company makes per share.
Okay.
So if a stock costs $50 and their earnings are $5 a share, the PE ratio is 10.
Okay.
You can compare that to the average for the market or other companies in the same industry. That'll give you an idea of whether the stock's price is too high or too low.
So if it's really high compared to others, that's probably a bad sign.
Right? It could mean people are too optimistic, thinking the company will grow more than it actually will.
Okay.
But it's not a perfect rule. You got to look at each company individually.
Makes sense. Okay, what about rule number 3?
This one might surprise you. Look for companies with high dividend payouts.
Dividends. I thought those were kind of old school. Don't most growth companies just reinvest everything instead of paying dividends?
That's true. A lot of tech companies don't pay dividends.
Right.
But Malkiel says focusing on dividends can help you find good companies that aren't overpriced. And avoid those that are growing too fast, maybe unsustainably.
Okay.
If a company's been paying dividends consistently, it usually means they're financially solid and want to give back to their shareholders.
Okay, I can see that. So what's his final rule?
This one's simple but important. Don't trade too much.
Wait, doesn't Wall Street want us to trade a lot?
They do. All those commissions and fees add up for them.
Right.
But Malkiel says trading too much hurts investors.
How so?
Every time you trade, it costs you money.
Okay.
You might have to pay taxes, and you might make emotional decisions just because the market's moving up or down.
So basically, the more you try to time the market, the more likely you are to mess things up.
Exactly. Remember the random walk thing?
Yeah.
It's really hard to predict the market. You're more likely to miss out on gains by trying to time it perfectly.
Okay.
He even quotes Warren Buffett.
Oh, really? What'd he say?
He said that being lazy can be good for investors,
Wow, I like that. So buy and hold is still a good strategy.
especially with index funds. They're designed for long-term growth.
Okay.
But even if you're picking stocks, patience is key.
He's not saying never sell, though, right? Sometimes things change and you have to adjust your portfolio.
Of course. Things change, companies change. Sometimes good investments don't stay good forever. Malkiel says you got to be tough with your losers. Sell them to balance out your gains and maybe save on taxes. But be patient with the winners.
Got it. So we've got Malkiel's 4 rules for picking stocks. Anything else important to remember before we move on to index funds and how to build a portfolio?
One more thing, time horizon. Malkiel says it's really important to match how you invest with how long you plan to invest. If you're saving for retirement way in the future, you don't have to worry as much about short-term drops in the market.
Okay.
But if you need that money soon, like for a house down payment, then you can't take as much risk.
So the longer you can wait, the more risk you can take because you have time to recover if the market goes down.
Exactly. It's about knowing how much risk you can handle. How much can the market move around without you freaking out and selling everything?
Okay.
And that brings up another point. Have some cash on hand, just in case. So you don't have to sell your investments at a loss if something unexpected happens.
It's all starting to make sense. We've talked about how markets work, those crazy bubbles, all the ways we can try to analyze the market, and even our own psychology. And we got some rules for picking stocks for those who want to try.
Yeah.
But I know Malkiel loves index funds. I'm ready to dive into that.
Let's do it. Index funds have gotten really popular lately.
Yeah, why is that?
Well, they spread your risk, they have low fees,
Hey.
and they're a really easy way to invest in the whole market without having to pick individual stocks.
Sounds good to me. But the world of index funds has changed a lot since he first wrote the book.
It has. We'll talk about all that too.
This is great stuff. I'm really learning a lot. Now let's dive into the world of index funds. All right, so index funds. Malkiel's been a fan of these for a long time, right?
Yeah, for decades, even before they got as popular as they are now. He basically says that for most people, trying to beat the market, it's just not going to work. It's better to try and get the same return as the market,
Okay.
by investing in a bunch of different things that track the market without spending a lot on fees.
That makes sense, but some people might feel like, I don't know, they're settling for average returns if they just follow the market. Like, don't we all dream of finding those amazing investments that'll make us tons of money?
Oh, absolutely. That's the whole appeal of those actively managed funds, right? You think you can find this, like, investing guru who always picks the right stocks.
Yeah.
But Malkiel points out that, like, the evidence doesn't back that up. Very few of those managers actually beat the market over time, especially once you take out their fees and all the trading costs.
So index funds are a way to avoid those high fees and the risk of doing worse than the market. What else is good about them?
Well, one big thing is diversification. You're not putting all your money in one place.
Okay.
With an index fund, you're instantly buying a bunch of stocks, like a whole market or a specific industry.
Right.
So if one stock does bad, it doesn't hurt you as much.
Right, right. But Malkiel talks about going beyond just the S&P 500, right? What other index options are out there?
Exactly. He suggests looking at broader indexes like the Russell 3000 or the Wilshire 5000.
Hmm.
These include a wider range of companies, even small and medium-sized ones,
Okay.
which can actually grow a lot. There's a whole world of index funds out there, not just the famous ones everyone knows.
So besides those big market indexes, what other kinds of index funds might people want to look at?
You can find ones that focus on specific industries, like tech, healthcare, energy. There are also index funds that track international markets, bonds, real estate, pretty much anything you can think of.
Wow, that's a lot. So how do you
You
choose?
got to do your research, figure out what matches your goals, and how much risk you're comfortable with.
Right. We talked about smart beta before. Can you remind us what that is and how it fits in with index funds?
Smart beta is a little more complicated. Malkiel talks about the good and bad sides of it. Basically, they try to do better than those regular index funds
Oh.
by focusing on certain factors like value, size, momentum, things like that.
Okay, so are they actually smarter? Can you give me an example?
Sure. Let's say you have a smart beta fund focused on value. It might have more of those companies that are considered undervalued by the market.
What does undervalued mean?
It could mean their price is low compared to their earnings, or they have high dividends. The idea is that eventually the market will realize these companies are worth more and their price will go up.
So you're kind of betting that the market will fix itself and those companies will get the recognition they deserve.
Yeah, there's some evidence that this works, but like always, Malkiel says past performance doesn't guarantee future results. These smart beta strategies, they can be unpredictable, and what worked before might not work again.
So smart beta isn't a sure thing. What should someone do if they're trying to decide if they should use it?
Really depends on their situation, their goals, and how much risk they're okay with. It's important to understand how they work and the risks before jumping in just because it sounds cool or made money for someone else. Even if a smart beta strategy does beat the market, it might be because it's taking bigger risks.
Right, okay. I'm seeing how this all fits together. So what are the key things you think people should remember from our look at a random walk down Wall Street?
It's been a great discussion. I'd say remember this. Markets are mostly efficient, so don't try to outsmart them. We all have biases that can mess up our investing, so be aware of them. And keep things simple. For most people, index funds are a great way to build wealth over time.
I like that. And Malkiel keeps reminding us, investing is for the long haul. Don't sweat the small stuff. Focus on your goals, be patient, and let your money grow over time.
And if you ever get caught up in the hype of some new investment, remember those stories from the past. The tulip mania, the dot-com bubble, the housing crisis. They all show us that markets can go crazy, and sometimes we just need to take a step back.
True, true. History might not repeat exactly, but we can learn from it. Well, that wraps up our deep dive into Burton G. Malkiel's A Random Walk Down Wall Street. Hope you found it helpful.
It's been great talking about this with you.
Remember, building wealth is a marathon, not a sprint. Stay informed, keep learning, and we'll see you on the next deep dive.